Comments made on the following paid commercial program are an expression of opinion only and should not be construed in any matter whatsoever as recommendations to buy or sell any financial instrument at any time.
Welcome to the Money and Wealth Show. On the program this week, tax tips with David Ingram, money commercials, and our special guest with a look back at a turbulent 2010, Michael Levy. Welcome to the Money and Wealth Show. I'm Sterling Fox, and our special guest this week as we wrap up 2010 is financial commentator Michael Levy. Welcome back, Michael. It's good to see you again.
Hey, Sterling.
2010 has been quite a year. I mean, when we sat down in the summer, halfway through the year, we were both kind of rocked by the turbulence in the economic world around us. It hasn't changed at all in the second half, has it?
Well, it's maybe even exacerbated somewhat. We had the currency crisis start up in the summer. You saw the riots in Greece, and you saw the a pushback. It was this sense of entitlement that Europeans seemed to have from their government. And when the debt crisis hit Greece first, but I mean it's spread over a lot of Western Europe now. But when the debt crisis did hit, you had people that say, wait a second, I don't want to take a cut back. Wait a second, I don't want to retire at 68 or 65. I want to retire at 62 or 60. Wait a minute, you can't cut back my wages. And it was, wait a minute, I'm not going to pay for this. And that really caused a bit of a revolt. There were riots on the street, there were demonstrations, there were strikes, and that was the start. That European debt crisis has spread now. It's spread into Ireland. It's spread into It's spread into Spain. You are going to see it. Italy, and to me, we've done Greece, Ireland, Spain could probably be the next. They have close to 20% unemployment, and just a little segue, Sterling, you can't affect a recovery if you have unemployment at that level. Coming back to North America, that's the big problem. In the U.S., for instance, with 9.8% unemployment, how do you affect a recovery if you don't have people working? And if 1 out of 10 are out of work, and structurally 1 out of about every 8 is out of work, not out of every 10 when you include long-term, when you include those who are in welfare and come off the unemployment rolls, those who are taking lesser sort of entry-level jobs instead of their good full-paying jobs, you can't have a recovery. So we've seen that malaise, which started in Europe in the summer, early summer, spread, and now we're seeing it come to our continent. Canada, not as much, but the U.S. for sure.
Well, the unemployment numbers, let's take a look at the differences between Canada and the United States just here in North America. The unemployment level in America is higher than Canada, but again, there's no reason there for Canadians to start being smug about much, is there?
Well, no, the last unemployment report, though we did add jobs and come down a little on the unemployment numbers, they weren't good jobs. They weren't the kind of jobs that are permanent. They were part-time. And as I say, it was positive, but mildly positive. But when you compare us to the U.S., then we're sitting fairly pretty. But what worries me, and worried the Bank of Canada earlier this week, was the trend-setting interest rate. They didn't move it. They left it at 1%.
Right.
And the governor came right out on Tuesday, and he said that they're worried about the recovery, very worried about the recovery, worried about where the Canadian dollar is because our exports are not selling at this high level, worried about the United States, our largest trading partner, and somewhat, but not quite as worried about what's going to happen in Asia, because we sell a lot of our natural resources, particularly energy products, into Asia. But again, there is a concern with that malaise. That's why you saw the Bank of Canada stay put. That's why you saw Ben Bernanke, for the second time in his career, go on to 60 Minutes and explain what was going on. And you saw the concern in his face also. That's why you saw Obama earlier this week agreed to the compromise on the tax cuts. And that's why you saw the markets, at least for a day, react positively to that event, because it is going to put more money in the hands of consumers. But all this is in reaction to times that are not good.
Well, when you and I talked over the summer, we had just experienced a very slight increase in interest rates. And you at that time weren't in the least bit convinced that that was a trend that was going to persist. And in fact, you were absolutely right.
It hasn't, and I don't know that it was a mistake by the governor, because when push comes to shove, truth be known, whether your bank rate is 1/4%, half of 1%, or 1%, does not stifle economic growth, does not stifle consumer spending, because it is really still at the lowest rates historically,
Sure.
what we would call emergency rates almost. But psychologically raising the interest rates when business isn't good can throw a damper on investment and can throw a damper on consumers. And I think that's what they're more worried about, is the damper or the blanket, the wet blanket they could throw over. So that's why in that rate announcement earlier in the week, the Bank of Canada made it well known that not only are they holding rates, but they implied that we could be mid to the end of 2011 before we see these rates start to pick up again. And to me, it's a double-edged sword, Sterling. They could start to pick up because the economic environment improves. They could start to pick up because of inflation caused by devaluation of paper money, costing more to buy because your money isn't worth as much, and that's also a big scare.
What did the interest rate increase over the summer do to the Canadian dollar? And as a second half of that question, what did the not doing anything with interest rates just a few days ago do to the loonie, if anything?
The first part of your question, psychologically it did a lot. Investors, seeing that the rate was changing on the Canadian dollar and there was a new trend starting to take place, wanted to be on the Canadian bandwagon for subsequent raises when they would then get a currency appreciation and more money for their money. Well, in fact, they were right. The Bank of Canada did raise rates a couple of times. Now, on hold, well, today it put a bit of a crimp in the Canadian dollar, so I shouldn't say today, but Tuesday of this week.
When the announcement came out.
Yeah, exactly. Right. It put a bit of a crimp in the Canadian dollar. On Tuesday, the Canadian dollar hit a high of 99.90 cents, and in fact fell under 99 cents during that trading day, just to show you, not what happened the rest of the week, but the volatility in the dollar and how it reacts to the market. So that dollar is something we're going to have to watch, and boy, there's a lot of varying opinions on that.
Now, a lot of people seem to think the Canadian dollar functions best for our economy in the 92 cent range. That's when our exports are suddenly more attractive and business seems to get better. Are we likely to return to that low 90s range?
Well, I would think we are, and actually fair value for the Canadian dollar when they do the fair value measure of economy and employment, like everything, is 88 or 89 cents US. So you're not far out at 90 or 91. It's funny, earlier in December, there were two forecasts by two bank economists, major bank economists, on the same day. One of them said Canadian dollar at 93 cents the first quarter of next year. The other said Canadian dollar at $1 to $1.01 in the first part or first half of next year. It can't be both.
That's right.
Yeah. And if I were a betting man, which I'm not, and had to go with which one, I would go with $1 going towards 93 cents, not $1.01.
Interesting stuff. Our special guest this week, financial analyst Michael Levy. Lots more to come here on the Money and Wealth Show. Stay with us.
Hi, I'm Larry Ray, President and CEO of American Manganese, Inc. Our project in Arizona is electrolytic manganese. We have a resource of 11 billion pounds, currently trading at $1.40 a pound. Our cost, 44 cents. For more information, go to our site at americanmanganeseinc.com or phone me direct at 604-531-9639.